forward yet. But look, let's say you're long on this chart, right? And the chart's building a course to the upside. What they've now done, look, there's Yao Ming. They've marked it down and brought it back up. So that tells you the fact that the price closed on the high of the bar, there's got to be some buying in there and some selling. What they've done, though, is taken out all the stops. That's damn right devious.
How would they know where to stop?
Oh, they know where to stop because they know how humans think. Most retail traders who trade anything can't afford to have big stops. Can't afford it. So they think they've been taught risk management, which is keep a tight stop. Well, the professionals know that. That's why they gun the market down, take the stops. That's very profitable for them. Which is why sometimes trading less contract size, but actually using a much wider stop is a far better principle. So here now, look what we've got here. Shakeout. No, there's no demand here. There's not no demand. No, that's not no demand. It's a down bar. It's closed lower. It's a test. This is a test. No supply potentially. Remember, no demand would be that at the top. No demand is probably something like that. Look, on low volume, it has to be an up bar, not a down bar. Yeah, you understand? So remember, no demand appears when. Always remember that we're looking at two things: an up bar or a down bar. An up bar is basically a price that closes higher than the bar behind it. We call it an up bar. No. Let me be clear. Right. Right, let's have a recap. An up bar is a price bar that closes higher. Correct, we call it an up bar. Remember we taught you yesterday, weakness appears on up bars. Notice before this decline here, we get a sign of weakness because it's on an up bar. Yeah, well let's look at this bar here. Right, who's hit up thrust? Well done. Yeah, you see, you've recognised that. It's a definite up thrust. What they've done here, this is a typical manoeuvre. This is how you read market manipulation. They have definitely manipulated the market on this bar, right? Definitely. But before they did it, TradeGuider said, look, you don't want to be long there because they're going to mark it down. It gives you a big up thrust. Now, it's an up bar. The volume is higher than the previous 2 or 3 bars. So this is quite high volume, okay? It's not, compared to the other bars, it's not very high at all. And in fact, the computer program will read that as actually low volume, as you can see. But even then, it's gone up and closed on the low. The next bar's down. If the next bar is down, you have to infer, and it's an hourly chart, there's sellers there. And then they do this. Now, that's very interesting. This is going to be a trade setup, definitely, for the next 24, 48 hours. Yeah, you're looking at this bar here, aren't you, I think? So, that one? That's not no demand. This one?
No, the other one. The left one.
This one? Yeah, that's it. Well done. You're right. That's no demand because there's. You see, when you talk about no demand, the volume is less than the previous 2 bars. That's important. So the volume, if you look at the previous 2 bars, the price goes up, and then you get volume less than the previous 2 bars. Yeah, the volume gets low. At this point, there's no demand moves the market sideways. It doesn't actually cause the market to fall. Now, the rule we teach you, look, this is important. You don't go short on no demand when you've got an uptrend, ever. Ever, ever, ever. If you see no demand, a red signal, but the market's trending up, write that down. Do not go short. If, however, you see no demand and the price is trending down, let's see if I can find you an example. Let's see if we can get you an example of no demand. I don't know if I can find one, so we'll find out. Everything's trending up right now, so see if I can. Actually, I'll tell you what, there is one I can show you, actually. Everything's up at the moment, absolutely. Well, there's no data for that, that's a shame.
Weakness detected.
Okay, let's have a quick look. We had some weakness detected, so...
Warning. Price target reached to the upside.
Okay, so let's have a quick look here. Okay, so the price target now on the trades there is actually going, it's pushed to the upside, okay? So now we've hit the 2400 where my limit, where my order was at 2398, and we're pushing up to 24. So we're looking to breach 24 at the moment. That's acting as resistance, clearly. Clear resistance there. So at least you hear the warning, the audible warning comes out telling you, if you're making a cup of tea and you're in the live market, as I often am, it tells price target's being breached to the upside there. Okay. Yeah, that's what's going on. So it's responding at the moment to the shakeout bar. Let's see if I can find you a decent example of no demand. And you know, this is classic, isn't it? All the markets are going up at the moment. Oh, okay, we might be able to get one here. Let's have a look at this. Here we go. Okay, here we go. Hold on. Here we go. All right, this is much better. Okay, so I can show you now where you do short, or at least where you get out of a long trade, whatever. Let's put that down there like that, just to show you the trend. Don't worry about the trend line for now, but just, do you all agree that the trend of price is down? Yeah, definitely. Now, this would be the opposite if it was going up, but it's going down, and we're looking to sell the market on these spikes up here. When Rob's indicators are going down, we look for no demand or up thrusts. Those are the two things. If you can short the crude palm oil, whatever, which you can, on the futures, you look to trade in harmony with the overall trend. This is a 4-hour chart of Barclays. It's a British bank. Okay? And we can see here the market falls. And all we're looking for now, remember, we trade in harmony with the trend. Now remember, we teach you that you want to short on up bars in a downtrend. Here, supply coming in. Now, there is an up thrust. Okay? So what we're looking at, see, as we're in a downtrend, as the price spikes up, it's designed to catch the uninformed traders to go long, which they do. They all go long on these spikes. Yeah.
What's the classical definition of a no demand?
Right, let's show you that, and I'll give you, this is a classic. Now, first of all, you've got to have weakness behind you, yeah? You've got no demand here, okay? Now, let's look very closely at this bar here, because this is a classic no demand bar. So what I'm going to do, that's on the 17th of August. Let's put up 30 bars and go all the way back to that day. Was it 17th of August, wasn't it? Let's go all the way back to the 17th of August. Okay. I think it was here. Right. What does Rob's indicator say regarding the trend or the momentum? Down. You agree?
Yeah.
Okay. So we'll look at this bar first. Okay. Now this is exactly what no demand is. We're at the top of the downtrend channel. You agree? There's the line I drew. We're at the top of it. So in a downtrending market, the best place to short is at the top.